guys, my name is Mr. P. I could put on an American accent forever, but I can't sustain it. So I'm going to go back to my Aussie accent. So here we go. Today we are talking about the components of the current account. Now, this is something that economics students quite often struggle with, but eventually get. I have a whole heap of confidence that you are going to get this. This is definitely gettable. Okay, there are two components of the balance of payments. The first one is the current account. I'm going to talk about it today. The second component is a capital and financial account. There'll be another video on that one, but I want to focus very much on the current account. It is the easier of the two to understand, but it will still take a while and a bit of extra effort, but you'll get there. Okay, so the components of the current account are actually quite detailed and specified. It is the accounting system that we use in terms of our relationship with the rest of the world. When I say our, we talk about Australia's relationship. So the first thing I really want you to look at is goods. We trade goods daily. That is accounted for in a financial period which is over a particular year. As you can see here, we have credits, and that is the money that we get because we have exported something. But there's also debits because here in Australia, we import a lot. As you know, we export a lot of raw materials and agricultural goods. We import a lot of technology and manufactured goods. That's reflected here in the current account in terms of goods. We also have services. When we provide a service to someone overseas, it could be a financial service, etc., we're going to get money coming in here. That's an import. Even in terms of the services we provide, those tourists that come into Australia, that's actually reflected here as a credit. But foreigners that provide a service for us, that's actually a debit. So that's the easiest thing to understand in terms of the current account. That's reflected there in monetary value. The next thing I want you to focus on is this thing called net primary income. Now, it is about money that we get because we have invested overseas, whether it be direct investment or portfolio investment. We are going to get some money because of that. For example, it includes profits from overseas, from our investments. It includes dividends from our investments. So if we invest in Microsoft and we get dividends, so that's in the New York Stock Exchange, and we get dividends from that flowing into Australia, that would be put into this primary income. But do understand that a lot of foreigners invest here in Australia. The money that they get from profits and from dividends is going to flow, or interest, is going to flow overseas. So that becomes a net primary income. Your next one is your net secondary income. Now, secondary income is things like government payments overseas or payments to governments into Australia. That is going to be a secondary income. A secondary income could be remittance. So any money that you are sending overseas to help family members in those particular countries, that will be under this secondary income as well. And I guess any other money that you're sending overseas, okay, it might be for some type of payment to you own a property over in Europe somewhere and you have to pay your real estate agent over there. That's going to be a net secondary income. Now, when you add these all up, you may find that you have what we call a current account surplus. You may find that we have a current account balance. We're not going to worry about that yet because you need to focus on something else later on. But you might also have a current account deficit. In Australia, we most likely have this thing called a current account deficit. That's probably what's going to happen. But you have to add all these up. So, I'm going to put some basic figures here. Okay? First one, goods. We might export a lot of goods, but we import a lot of goods too. In terms of the value of that, I'm going to put down minus $2 billion. Okay? Because we are importing a lot more than we're exporting. So our debits are much greater than our credits. But in terms of services, we there might be more credits, so more money flowing in because of the services we provide compared to foreigners, so that might be $1 billion. Our net primary income, Well, let's face it, a lot of foreigners invest in Australia compared to what we invest overseas. So in terms of the profits and the dividends that flow in, more flows out than actually flows in. So the net already takes that into account. So what comes in compared to what goes out, and it might be something like minus $20 billion. Okay? And the last one there, net secondary income, well, let's just be really positive here and say that more money is actually flowing in for a particular reason, and let's say that's a $2 billion flow in as well. When you add it all up, and let's go negative 2 billion plus, I'll write that out there, a billion, so at the moment, together, that is negative $1 billion, okay? And then we look at these here, so negative 1 billion plus negative 20 billion makes it negative 21 billion, plus 2 billion makes it negative $19 billion. That is what we call, because there's a minus there, that's what we call a current account deficit, so a CAD, okay, current account deficit, so that's for deficit, of $19 billion. I hope you enjoyed this little lecture. This is my first go at it.